sorry, I lost my place there. So I'd like to call this morning's meeting to order. It is now 9 o'clock on the dot. Amber, will you please take attendance?
Yes, thank you, Holly. Okay. Adrienne Cochran.
Present.
Daryl Dudzinski.
Present.
Mike Soltis.
Present.
Alex Marcelino has not yet joined us. John Scott. John has not yet joined us. And Holly Williams.
Present.
Thank you. We have a quorum.
Thank you. So I would like to take this opportunity to just welcome and thank any of the members of the public for joining us this morning. And I'd also like to ask for a motion to amend this morning's agenda to include voting on the May minutes.
So moved.
A second?
Daryl.
All in favor?
Aye.
Aye.
Aye. Any opposed? Any abstentions? Okay, so I'd like to ask the committee for review of the May 27th, 2022 minutes and call to approve. Can we have a motion to approve the May 27th minutes?
Is it the June 24? I'm sorry.
Oh, no, that's okay. So last finance meeting, we tabled a vote on May, correct, because we didn't have a quorum. So I'd like to just,
Okay.
Yeah.
You're going in order. Got it. Sorry.
Yep.
Thank you.
Sorry, no problem.
So with that, a motion for May 27.
Thank you, Daryl. A second?
Second. Mike.
All in favor?
Aye.
Aye.
Thank you. Any opposed? Abstentions? All right. So the motion carries. Thank you all for allowing us to take care of that this morning. And now we'll move on to a review and approval of our June 24th, 2022 meeting minutes. So once again, can I have a call to approve?
Motion to approve.
Second, Daryl.
All in favor?
Aye.
Aye.
Any opposed? Abstentions? All right, the motion carries. Thank you all. We'll transition now into our presentations this morning. And we're going to have Harindra and Audrey. Would you please provide us with our actuarial analysis? And they're joining us from the Spring Consulting Group this morning.
Hi there, good morning. Thank you for having us at this committee meeting. My name is Harindra Sebastian, Senior Actuary here at the Spring Consulting Group, which is part of Alera Group. Joining me is Audrey Wang as well, who's also an consulting actuary at our firm. So with that, I just want to make sure will you be pulling up this slides, or do you want me to share my screen?
If you have them,
yeah, you should share your screen and run the, yeah, you should share your screen and make the presentation.
Okay, I will do that right now. Okay, so the purpose of this piece that we presented is to provide you with the actuarial results as of June 30th, 2022, as well as a projection. We presented a 3-year projection within these results, and we'll also talk about the solvency of the fund as part of this presentation. Okay. Just a little bit about Spring Consulting, who we are. We're based out of Boston. We're part of Alera Group, which is a national consulting brokerage firm. We provide strategic consulting and actuarial services across the spectrum of employers, all the way to insurers, states and government entities, as well as captive owners as well. And we have a specific focus on paid leave and medical programs. We do work with several other states as well. Okay. just on this, as I mentioned, we were hired to conduct an independent actuarial analysis, really looking at the solvency of the trust fund. And also as part of that, what we did was we looked at what is the current state as of June 30th, 2022. So looking at I'd say the extended period, January 1, 2021 to June 30th, 2022, looking at the actual results as reported, and then making a projection forward for 3 years to look at what the results might look like over the next 3 years. So we've got that, talk a little bit about that. And then as part of that, understanding or giving you a sense of the solvency of the fund itself, whether we think there's sufficient funds in there, and looking at a few of the metrics behind that. So I'll get into the results right now. Before I do that, just want to make sure that everybody's okay with the flow and the plan. Okay, going.
Yes, thank you.
Okay. So this might be a little bit hard to see, so I'll zoom in a little bit. The first column here is intended to be the actual results reported January 1, 2021 to June 30th, 2022. The next three columns represent the projections for fiscal year 2023, 2024, and 2025. And those periods are July through June each year. In each column or in each row, really, we have a section on revenue. And that's made up of payroll contributions and investment income. Then we have a section on expenses, though that's made up of the claims, benefit payments, and any other expenses such as administration costs and any seed and bond payments. So that will give us the net activity for each period. And then below that, what we have is the cumulative fund balance, which I'll talk about in a minute. Okay. Just looking at the actual results for the period January 2021 to June 2022, payroll contributions on a paid basis were $519 million. Contributions for the current fiscal year that have not yet been received. So this is related to the 30-day or the 1 month grace period that people have. So that as of June 30th, there's still 1 month left to collect contributions, and we know a lot of the contributions for the period, I guess, April through June 2022 will come in right at the end of when it's due. So we've got an extra amount here for contributions in respect of the current period that have not yet been received, 113 million. So that in total is 632 million. Okay. Investment income was 1 million in the fund. So in total, we're at about 633 in terms of revenue. In terms of the expenses, we have paid claims of about 100 million, 102 million. And then we have a reserve. So this is in respect of claims that have been incurred during the period, but the payments have not yet been made. I'll talk a little bit more about that in detail in an upcoming slide. But this is intended to represent costs still associated with the current period, but some of the claims have not yet been paid. So it's sort of funds owing, if you will. So that's 142 in total in terms of the claims payments. And then in terms of the other items, we have the authority administration costs, which is 19.4 million. We have payments to AFLAC for administration, claims administration of 13.3 million, and a seed capital repayment of 3.8 million. So that's a total, their subtotal of 36.5 million. Okay. So total expenses 178.5 million. Net activity, when you take the revenue minus the expenses, 454.6 million. And that effectively represents the fund balance as well at the end of this period, because we started at zero. Started the period at zero. And that, if you were to look at this detail here, and I'll just spend a bit more time on this right now, the contributions for the current period not yet received is 113.3 million. I mentioned that above. And then we also have the reserve for claims that have been incurred but not yet paid. So that's 40 million. So if you were to back those out effectively, you would get to 381 million. which is the actual fund balance, just knowing that there are payments to be received and payments to be made coming out of that in respect of the current period. Okay. I thought it would be important for me to spend a little bit of time going through the detail there, just so that when we look at the projection, all the line items sort of made sense to everybody who is listening. In terms of the 3-year projection, what we have projected in terms of total contributions is, and keep in mind that this is a 12-month period, whereas the first reported period is an 18-month period. Total contributions were 478.0 million, and then it goes up to, for fiscal year 2023. Projection for 2024 is 500 million, and the projection for 2025 is 517.8 million. Okay. Investment income is higher, it's in the higher rate of return, and that is 4 million for fiscal year 2023, 4.8 million for fiscal year 2024, and 5 million for fiscal year 2025. In total, revenue, you can see, is about 480 million, growing to 522 million. In terms of the expenses, so we have a full year, and we're expecting the expenses to grow as well. In terms of our projection, we have 364.6 million for the period in June 2022 to July 2022 to June 2023, 420 million for the next year, and then 464 million for fiscal year 2025. Expenses, you can see, is hovering around 50 million for each of those years. And so in the net activity, you can see, is positive each year based on this projection. 69.7 million, 36.9 million, and 9 million for each of the 3 fiscal years. And basically, because the net activity is positive in each of the years, we do expect the fund balance to grow accordingly. So where we ended up June 30th for 454.6 million here, that is expected to grow to 524.3 million, 561.2 million in the following year, and 570 million in the next year. Okay. I'm going to make a few comments on the approach and methodology and assumptions next, and then talk a bit about the reserve as well, and then the solvency. Okay. So just before I go to that, this graphic just illustrates the same numbers that I showed before. We have revenue up top in the blue line. You can see it's 633 million and about 482 million, 500 million, and 522 million. We have spending or expenses, 178.5 million, 412 million, and so on here in the orange line. And then the fund balance is represented by the green bars, as you can see here. And it's the same numbers we talked about previously. Okay, a few comments on the assumptions and methods that have been noted here. I'll hit the highlights for the purposes of this discussion. The contribution projection is based on looking at population changes as well as wage growth after factoring in what has been received to date. And there are several assumptions documented in the appendix of this deck, which I believe you'll receive as well. Investment income is based on 0.75% of plan assets, and that's looking at the state of Connecticut Treasurer's income fund. So that's based on a historical view and expectations there. The claims projections themselves are based on looking at emerging claims experience from the state of Connecticut's own data, as well as looking at claims experience from other states. And this is an important point I just wanted to highlight. What we have is very limited data from the state of Connecticut today, but we expect as the program goes forward, we'll get more and more data as we have more months and more years of data. So we will be able to refine and adjust the assumptions based on your own data. But as it stands today, as sitting early in the program with limited data and limited really completed data, we did have to rely to some extent on data of other states where there are similar programs, making adjustments to account for any differences between those programs and the state of Connecticut's program. So we took an approach where we looked at your data, gave it some level of credibility, and then looked at other state data to develop our overall assumptions for this specific projection. But what it does mean is that as time goes along, we'll be able to rely more on your data, and there'll be a point where there'll be enough data just for the state of Connecticut where we can fully rely on your own data to make our assumptions. So just keep that in mind. The assumptions underlying the projections are based on several sources to come up with our best expectations. But we do need to continue to monitor that over time and make adjustments and refine the numbers as it goes along. And that's pretty standard, a standard approach for this type of claims projections. Okay. The other pieces here covered population projections. So that's an important one. So that reflects assumptions around the proportion of the population that will be part of private plans and the take-up rates, as well as state employment levels. So if, for example, you have more people and we expect a small increase in private plan take-up rate compared to where we're at today, that would reduce the covered population by a little bit. And I think we've assumed a 1% increase in that level, in the level of private plan take-up in that example. And then in terms of the expense projections, we do have a budget for the authority for future current budget, and then future years are based on the projection is based on taking an anticipated increase in the budget expenses, looking at each line item separately. I'll keep going in the interest of time. The next item is our reserve estimate as of June 30th. So the reserve estimate itself is made up of three components. One, claims that have been approved and that are open today with outstanding payments still remaining. Claims that are pending, so claims that were incurred, they're pending, we know about them, but they haven't been approved one way or the other. So there's an estimate for the claims related to those pending claims as well. And then there are claims that have been assumed to have been incurred, but not yet reported. So they were still incurred during the period, they just haven't been reported yet. So we don't know about them, but they are still part of what we've made some assumptions to estimate what that reserve will look like. And as time goes along, we'll get a better sense of if our assumptions were exactly accurate or how close they were, but because we'll see actual claims emerge based on for all of these items. So in total, what we have is $40 million estimated of reserves for claims incurred during the period but not yet paid. Case reserve was 10 million. Pending claims reserve was 23 million. So these are claims we know about. We just don't know. They haven't yet been adjudicated to be approved or not approved yet. And then the incurred but not reported claims, that's 7 million. So in total, that worked out to be $40 million. And that number, 40 million, is reflected in the financial statements I showed before. Okay, so this is the fund solvency slide, and it's intended to cover off the three metrics that we determined would be appropriate to look at for the state of Connecticut's fund. Okay, the first one was a comparison of the reserve relative to the net fund balance. Okay, so looking at that, the reserve of 40 million relative to the net fund balance of 54.6 million. If you were to remember this number here, 454.6. So we're comparing the fund, the reserve of 40 million relative to the fund balance. So the reserve is very low relative to the fund balance, so it is much lower than the target. So we classify that as it meets the target. Okay. The next metric is the contributions relative to the fund balance. Again, lower than the target. So The contributions relative to the fund balance is 0.9 to 1, which is much lower than the target of 3 to 1. So we said that meets the target as well. And then the third item is the reserve, the adverse losses over 1 year relative to the fund balance. And so we looked at some assumptions around what an adverse loss scenario could look like. And based on that, we compared that to the fund balance. That came out to be 0.3 to 1, which is lower than our target of 0.5 to 1. So looking at it overall, we classified this as the metrics being positive, and that overall actual is lower than target. So we classified that as meeting the target. I just want to spend a little bit more time on each of these items, but I did want to kind of give the highlights of what we were looking at from a fund balance and solvency of the fund view overall. Okay. So just looking at the first one, we have a bit more detail in the following page. Yeah, the reserve versus the fund balance. So it's the amount of money, like I said, that we want to set aside in respect of expected claims for events that have already happened. And looking at that, the net fund balance was already net of the reserve. The fund balance is significantly higher than the reserve, so we classify that as meeting the target. And then in terms of contributions, again, making sure that the fund has is adequately large enough to cover higher than expected contributions, if you will, or claims. It's a good metric to also look at from that standpoint. And we determined that overall it met the target of 3 to 1, which is significantly lower than that. Okay. And I mentioned the last one was looking at the adverse losses. So looking at that, we have a fund that covers adverse losses as well, a scenario where you do have adverse losses. So it's less than 0.3 to 1. So it's 0.3 to 1, so it's less than 0.5 to 1. So classify that as meeting the target as well. Okay. So I think that's the end of my formal comments. Just in summary, overall, the net activity for the period was $454.6 million, and that resulted in a fund balance of $454.6 million. And when we looked at the fund balance, we determined that the fund balance meets the target funding metrics. So that was a positive, and that was probably the key point we wanted to make. And then over the next 3 years, when we look at our projection, the fund is actually expected to grow based on the current assumptions, but because revenue is higher than expenses. But we do want to continue to closely monitor all the factors that are impacting the fund, including claims projection, as well as the contributions, and based on several factors, including just changes in employment, public health matters, such as COVID-19, because we do want to continue to monitor it and refine our projections and make sure that we have accurate and solid projections for the state, for the authority as well. So I tried to go through this fairly quickly. I think I've covered it all. And there are some slides in the back here that have some of our assumptions in more detail as well, which I'll point to as needed.
Thank you very much. That was very informative. Are there any members of the committee that have any questions?
Holly, this is Mike. I have a question.
Go ahead.
Excuse me. Harinder, thank you very much for your presentation. Could you go to the first slide that you had? The projections, the 3-year projections, the first financial slide. Okay. So if you look at the net activity number, as I look at it, for the next 3 years, it declines approximately $30 million a year.
Mm-hmm.
And if I continue the trend line to year 4, which I know you didn't look at, it's a negative number. Negative approximately 20 million, right?
Mm-hmm. Yep.
So the first 3 years look good, but year 4 causes me concern. So am I interpreting that correctly?
Corinne, would you like me to answer that or?
Sure, yes.
Okay. So no, Mike, you are interpreting it correctly. And so we did ask, we saw the same trend. So we asked Harindra and his team to just do some preliminary analysis of years 4 and 5, which we haven't had a chance to dig into very deeply yet. So we asked to just give us a chance to take a look at that, and then we can come back and answer that question more specifically. So there were assumptions that are on that and on that very last slide in the appendix that were applied to these 3 years. And we wanted to make sure that those were the same assumptions that were applied to years 4 and 5, so that we could come back to the committee to make sure that those numbers are as accurate as these numbers, and then explain what the trends are for the next 2 years, and then determine what our courses of action might be. So, you know, the statute only has a couple of things we can do as it's currently drafted. Actually only has one, which is we reduce the benefit rate in order to maintain the fund solvency. So the questions that might arise if we went out to years 4 and 5 and we saw the net activity continue to go down and maybe even the fund balance being affected by that, would be those other questions. Well, then what adjustments would we need to make? What would they look like? What would we be recommending? How long would they have to be made? Would there be an opportunity to reverse those changes? And we weren't really ready to answer all of those questions today. But we did want to show the trend and say that we're very aware that the trend exists and that we just need a little more opportunity to provide more detail as to what the trend means.
Okay, yeah, thank you. That's
You're welcome.
Obviously an ominous trend.
Yeah, we agree.
So, okay, well, we'll look forward to a later meeting where we discuss years 4 and 5.
Yep, absolutely.
Thank you.
I had a follow-up question if there wasn't anybody else from the committee that had a question. So you actually answered my initial question on your last slide with regards to assumptions. I had a question as to what other economic factors are evaluated as part of this actuarial analysis to project out year trend lines, but it does seem as though you're including economic factors such as, you know, broader things going on in the labor market and things like that into your analysis. So I think that question is answered. But my next question has to do with, I understand that we're a relatively new plan, and I asked this in a prior meeting actually, but do you have any insight onto how the Connecticut plan in its first year compares to the other plans that you included as sort of proxy data for your analysis?
Yes, I'll make a general comment because we did look at data for several states. So in general, you do expect to see some lower take-up of the program, like people basically going out and getting claims, making claims and so on. But we did see that the current data suggested that the utilization of the program looked relatively lower than other states, even in year 1. So we want to monitor that as well. And then you know, one of the factors that you'll see underlying these assumptions is an increase in utilization. So a higher level of claims, if you will, over in the future years. So we projected that forward because we kind of started with your own data, and we ended up with assumptions that are more based on other states. And there's a bit of a trend line going upwards of the increased incidence of claims. And that's actually shown in this presentation material here in this incidence rate assumption. So here we do have incidence rate assumptions. Basically, this is the percent of the population that is going to go out and have a claim for own health or pregnancy or for each of these categories. And you'll see this year, the assumption in total works out to be a little under 4%. Whereas if you look at 2 years out in the projection, we do see an increase that's baked into our assumptions today that suggests that the incidence rate might be higher. But these assumptions are all, again, assumptions. So we do want to monitor your own experience and see what truly comes to pass. And then if we see, for example, that your experience is truly lower even going forward, we'll look at it and say, okay, well, maybe our assumptions should be lowered even in the outgoing years. Or if you see that your claims experience has gone up a lot, we'll look at it and say, okay, for our upcoming projections, we want to refine the numbers and increase the utilization. So I know that was probably answered your question and maybe gave you a bit more, but hopefully it helped clarify a few things.
No, that was very helpful. Thank you. My last question might actually be something that can't be answered until a future date after the team has had an opportunity to review your out-year analysis. But is a sensitivity analysis going to be provided should the authority need it to kind of weigh in on whether or not we need to, make any decisions with regards to changing various things or proposing various changes relative to what we're projecting to see in the out years? Is it going to be a tool that the team can have at their disposal should they need it?
Yes, we will provide sensitivities to assess that for sure. Yes. Yeah.
Okay, I thought so. Thank you. That was helpful. Does anybody else from the committee have any additional questions? I don't see any hands up. Thank you very much for this presentation. It was very informative. If there aren't any further questions, then we'll close out this item.
Thank you very much.
Dave, thank you very much. So we're going to move on to budget review of spending to date. And Dave, if you're ready, if you'd like to kind of walk us through where we are today.
Yes, thank you, Holly. Good morning, everybody. We'll be walking through the results for the month of June and our fiscal year end. My turn to share the screen.
You can see your screen, Dave.
Thank you, Amber. Okay, so for the month of June, our expenditures were $2.9 million. And for the quarter, that would make it $5.3 million. Now, that does put us over budget for the quarter for $1.7 million. But as I'll get to in a second, that was because of the spending that we had in the last quarter, and specifically in June, encapsulated some items that were budgeted earlier in the year, but just were paid in June. So for the $2.9 million, the largest expenditure we had was $1,163,000 for 6 months of IT support for the employee contribution platform. We had received the billing from Slalom later than we normally did, and we had some questions on the billing, which were answered and resolved by June. So that's when we paid all the invoices. Also for the month of June, there was $561,000 for salaries and related expenses. That does include the lump sum payments that were discussed at the last Finance Committee meeting and the last board meeting and approved by the Board of Directors. We also paid $340,000 of seed money from the remaining unused seed money we had. So that zeroes out any seed funds that we had left. So we didn't have to repay the seed money from contributions. So that was a benefit to the fund. We also paid $250,000 for the contact center. That was 2 months of expenses. We caught up with that one as well. We paid over $198,000 for grievance adjudication services to the DOL, sorry about that, for the appeals work that they're doing on behalf of the authority. And those were for services through March 31st. And so they will be billing us quarterly going forward on that. We appreciate all the work that they're doing for us on that. We also paid $152,000 as a final payment for the completion of the build of the appeals system that DOL had done. So that was the final payment of our share of that. And we also paid $99,000 for insurance. That was a prepayment for the next fiscal year's policies, for some of them anyway. And we had $73,000 in outreach expenditures and another almost $46,000 for some work paid for from the bond money for the employee contribution system. Cumulatively to date, the authority has spent $28.3 million, and $15.2 million of that was spent in the current fiscal year. I'm happy to say, in terms of the operational budget, we came in at about $3.2 million, better than budget for the year. And again, the typical expenditures that the authority spends on were for the employee contribution system, $8.5 million, salary and related of over $7 million, post-production support of 3.3, support teams of 2.7, work on the benefit claim system, including the DOL appeal system, was 2.6 million, outreach of almost 1.2. And then there were some other remaining expenses that tie into the almost $28.3 million that the authority has spent to date. Looking at our bond funds, out of the $50 million that we have authorized, we do now have $16 million allocated and made available. The $3.8 million that was approved by the Bond Commission in May was formally allocated and made available by the Office of the State Comptroller and OPM as well. So thank you for their assistance with that. We haven't actually spent any of that additional money yet. So to date, the authority has spent $11.2 million of bond funds. $198,000 of that was in June for the items I had described before, which were for work on the employee contribution system and the benefit claim system, the appeal system in particular. That leaves the authority about $4.8 million left of funds that are available to spend on future projects. Moving on to contributions for the month of June, the authority received almost $800,000 in contributions, $372,000 in investment income. We did pay out $27 million of benefit payments this month. If you look at the trend line, you'll see normally we spend about $20 million. It was higher in June. The biggest driver of that is because the fund reimburses AFLAC on a weekly basis for benefit payments. And June was one of those months where there were 5 weeks of reimbursements. So that was the main driver of the why there was the increase in the benefit payments. And so then at the end of the month and the end of the year, the closing balance was $383 million. I also do want to point out that you might remember that the authority had $20 million in an impressed account at AFLAC. That amount was subsequently reduced to $12 million. And so the $8 million was transferred back into a CTPL account. The impressed account is really just another part of the fund balance. It just happens to be sitting at AFLAC. We had shown it as a disbursement before, but it's really not a benefit payment out. It's just moving the money from one account to the other. So it was more appropriate to show it as part of the fund balance rather than as a disbursement going out. We discussed that with our auditors as well as we were starting the planning stages of the audit, and they agreed. So that's why you see this breakdown down here of what makes up the 383. So there's 12 million in the Aflac impressed account and $371 million in Connecticut paid leave accounts. For the year, the activity on a cash basis, you may get deja vu because Harindra had mentioned these numbers before, but our contributions through the end of June were over $518 million. Investment income was $1 million. Our benefit payments were over $102 million. The benefit admin expense was almost 11.4. That was the monthly payment that we make to Aflac. The CTPL administration fee was as budgeted at $19.4 million. And the seed repayment was $3.2 million, a little better than what we had budgeted because, again, we had unused seed funds. So we used those to pay back the state as opposed to paying them from contributions. So again, on a cash basis, that leaves us at $383 million in the fund as of June 30. No projections this month because we are at June 30, so I gave you the actual results. Does anybody have any questions?
I have one quick question, and it could just be that I just don't understand something. But what's the other component of that $12 million? Sorry, your last screen, the last lines where you're coming up with your final balance. I see what the 8 million is. What's the balance? What's the other 4 million?
I'm just going to reshare my screen just to make sure we're on the same page. Literally, Holly. Okay, so you're talking about the 12 million down here, and you're talking about the 371 million down here.
Right, I see the asterisk. 8 million is transferred from Aflac impressed account. What's the balance? What's the 4 million?
Oh no. What happened was I'm going to go back a page.
Okay. I think I'm missing the flow through.
Okay, I'll walk it through with you. Not a problem. Apologies if I went too fast. Okay, so originally way back in December, the authority had to deposit $20 million into an impressed account that allowed Aflac to make the benefit payments. And then every week we reimburse that impressed account with the actual benefit payments. But this allows Aflac to make the payments in a timely manner and not wait for us to pay them. And that was determined to be $20 million. That was based on a very conservative estimate on how much we expected benefit payments to be. So a few months later, the actual activity has been less than what that conservative estimate was. So Aflac said, we've determined we only need $12 million instead of the 20. So the difference between the 20 and the 12 was 8. So $8 million was taken out of the impressed account, and then it was transferred into the paid leave accounts in the month of June. So if you're wondering, well, how come the CTPL account number didn't go up? Well, we also made benefit payments that month of the $27 million and some other payments. So, and since the total of that was almost $29 million, that's more than the 8 million that came in. That's why the balance went down.
Thank you. I apologize. I missed your flow through on the preceding slide. So I'm reconciled now.
Okay, no apologies. Any question's a good question. Anybody else?
Dave, I have one question. And
yes, Mike.
You may have touched on this and I just missed it. So our fund balance at the end of the fiscal year is 383 million, right?
Correct, sir.
So a year ago when we budgeted for this fiscal year, what did we project our fund balance would be at the end of the year?
Okay, so the budget was had budgeted at $11 million to be at the end of the year. So in terms of budget, we are that far ahead.
Well, that's extraordinary, to the point where it raises a question about our budgeting, doesn't it?
Well, we had, oh, Andrea, did you want to interject? You're on mute, Andrea.
I'd love to interject if I could find the mute button. So, I do have a couple of slides that might explain why this difference is so significant and that it's not necessarily a measure of budgeting. If you don't mind my sharing those, it really shows the difference between the projections and what we're actually paying. And you can see those differences are pretty significant. And that's really what's driving the number. So let me, knew somebody was going to ask this question. So I just put a couple of them together right now. So let me just show them with you. I'll share them with you. If I can remember how to share my screen. Okay, here we go. All right, so you can see in the bar chart form the number. So the actual claims that we paid to date are $112,000. And this report is as of July 9th. The actuarial projections were considerably higher. And that is why, and these are the actual claims that we're paid today. And so you can see there's a significant difference, and that's really part of what's really driving that number. And then I also have it, if it'll cooperate with me, let me put it in slide mode so it's easier to see. Apologies for that. All right, so then here's everybody takes the information differently, sort of the bar chart. And I really want to thank Amy on our team who puts this together for us regularly. And so I totally took this out of Amy's report. I'm not responsible for this. So Amy created this on our finance team. She does this. She provides us with a periodic report of the actual claims that were paid and what the actuarial projections are. Here you can see there was a bar chart I think really starkly identifies and portrays where our challenges might have been, but really where we are. So we have it there. And then here are the actual numbers. So we are actually that far ahead because we budgeted based on the actuarial projections, which were very conservative. The actual claims activity is actually appearing to be much lower than that. And that is why we have that significant difference. And I don't know if that's helpful or not, but I just thought I would offer that as a part of the explanation.
No, that is helpful. I mean, it explains, I guess, 150 million of it. And I realize we're early on in the process, so we don't have a lot of experience to base data on. And I'm also mindful that in the actuarial projections, they project an increase in claims. So that number may go up. But obviously, I know you keep an eye on all of the numbers, but I just think we need to just pay close attention. And you're already doing this. I don't mean to imply that. So no, thank you for that explanation.
And if you did, that's fine. That's what board members are for. They're supposed to tell us what we're supposed to be doing. So no one's offended. Believe it's fine. And if we're missing something, then absolutely tell us that. I think this analysis that Amy provides periodically is really very helpful. It really allows us to closely monitor the fund with the tools that we have available. And our claims run rate is somewhere between 6,500 to 7,000 claims that are filed monthly. But that doesn't necessarily mean that all of those claims are approved. They're obviously all adjudicated and decided in some way. But the approval rate right now and the actual benefits that are being paid out are those actual numbers. So she runs that report fairly frequently. So it's pretty accurate. And we have, so finally what I'll say is that we have this very smooth, effective approval process for all of our expenses. Thank you, Locke, for creating this thing that's just really unbelievable. And if I had to say it, the whole state should use it, but you can't have Locke. So Locke created it's really great. And every week when I approve that number, it runs about 5.8 million, 5.6 to 5.8 million in approved benefits for payment every week. So we're about right. And that is based on the invoice that AFLAC sends us every week for the amount of money they need to pay approved claims. Okay.
Thank you.
You're welcome.
I'll also add to that, Andrea, is that we also budgeted contributions coming in very conservatively at the time, because by the time the budget was approved, we had just started the contribution process. I think we had maybe a quarter's worth of contributions. So, or maybe not even that. It was close. So we weren't sure how much we were going to get. So we did budget that number conservatively as well. Obviously, it's a year later. We have more experience when it comes to contributions. So we have budgeted for the new budget. We have budgeted a number based on that activity. But as you pointed out before, Mike, it was very early in the process for everything. So we just, we took the best information we had at the time based on the actuaries and budgeted conservatively.
And it's obviously better to end up on the side we're on than on the wrong side.
Well, yes, agreed. I won't disagree with that. But certainly as time goes on and we get more information, we incorporate that in our budget, just like we incorporated into the actuarial study to come up with the best estimates we can to go forward.
Thank you very much.
You're welcome, Mike. Anything else?
I don't see any additional questions for you, Dave. Informative as always. We're going to transition on to an update on our claims administration. John, if you'd like to share your screen and walk us through our claims.
Hey, thank you, Holly. Good morning, everyone.
Morning.
I'll share my screen.
I can see your screen, John.
Thank you. Okay, so claims update with data through July 18th. So claims filed as of July 18th, 56,315. And as Andrea indicated, the average intake, including that spike in January, is approximately about 7,400 claims monthly. And then claims received status, all approved claims are running at about 50% at 28,135. All denied claims are running just under 18,000. That's about 32% of the total. And pending claims are running at about 6,300, representing 11% of the total as well. And we also included some statistics excluding the over 5,000 COVID claims that we received and the adjudication thereof. So when I separate those out and run the approved and denied claims, you can see the results here. The approvals go up to 53% rate and the denied claims drop to a 27% rate, in that I want to say approximately 85% of those COVID claims were denials based on mostly on not meeting the threshold of a serious health condition. And then claims by reason. So again, the employee's own illness is by far the largest, followed by bonding and pregnancy and childbirth and care of a family member. And then the other table on the right here is also items with substantially lower numbers of claims associated with them. And then some demographic information, the claims by age group, 26 to 41 is by far the largest group of filers, followed by the 58 to 76 group. And then on down the scale here, 42 to 57 and 18 to 25, with a very small number of claims filed by 77 to 94. Again, looking at the claims by gender, the female claims are running over twice the number of male claims that have been filed. And then looking a little deeper on some of the demographics, claims by age group and leave reason. And again, you see the same information here, just broken out by the type of leave that each of these age groups are filing for. And you can see own injury and illness being the largest, although bonding and pregnancy in that 26 to 41 group is substantial as well. Then leave reason by gender. So when we look at the demographics underlying this, again, you can see that the number of female filers is significantly higher and outstrips the male filers in each category here. And then claims by continuous, intermittent, and reduced schedule. And again, the continuous claims far outstrip the intermittent and reduced schedule. Makes up the vast majority of claims that are being filed. And then top 10 towns utilization. You have seen this slide before. We only calculate this monthly. So this is the same slide from the prior board meeting. It'll get updated again at the end of this month. But again, a mix of rural and suburban as well as urban towns in that mix when we look at it on a claims per 10,000 resident basis. And approved to date by leave reason. Again, when you look at these approvals, interesting discussion we had with AFLAC recently focusing on pregnancy and bonding claims is that they comprise about 36% of total intake, but they actually comprise about 47% of approved claims. So the rate of approval on pregnancy and bonding claims is substantially higher, and that is one reason why we are focused on that element with AFLAC to try to identify ways to process those more efficiently and potentially treating the pregnancy and bonding claims as tandem events, if you will, and also a bonding claim by a spouse or the father of the child as a companion claim, finding ways to do that more systematically to improve the flow, the workflow through there and efficiency and productivity. So we're having some discussions with AFLAC about that to try to improve that process for those folks. And then looking at the monthly claims customer care center data, I think, Mike, you may not have been there for the prior board meeting, but you had requested some more trend analysis related to the call center information. So we put together the last 3 full months here, April, May, and June. And you can see a few things here. You can see the total calls, the percent answered in 30 seconds, and abandoned calls with the call volume that came in, and the associated percentages answered in 30 seconds and abandoned. The abandoned rate is down at the bottom, and the calls answered in 30 seconds is up on the bar line up on the top there. And then hold time and handle time, and they're looking at a few different items with respect to that. There's an average cumulative hold time while you're live with an agent. So if you're receiving customer service from an agent and you are put on hold for any reason while they are looking something up, etc., verifying information, that shows as cumulatively there. The maximum initial hold time is when waiting to speak to an agent about your claim, and then the average handle time just shows the amount of time that they're typically on the phone with a customer, and the average after call work time is listed as well. And then on the approved insights here, you can see some of what Dave showed you with respect to the amount of payments that have gone out. And this one was through July 16th. So number of payments released, almost 200,000 individual payments released to almost 23,000 unique employees, and total gross of 109.5 million. Payment types are still holding steady. The vast majority are receiving direct deposit, and 11% now for debit card. Okay, and that concludes the claims presentation. Are there any questions?
Sorry, no, I do.
Oh, sure, Terrell.
So a couple questions. Did we ever get an answer from the IRS on whether or not the insurance is taxable for 1099-G purposes, et cetera?
That is a good question. With regard to whether that is taxable or not, I know Aaron had some information on that, and I don't recall what the final outcome was. I think there was still an open question pending with IRS as to whether or not that is a taxable event. You can certainly correct me if I'm wrong, either Aaron or Andrea, but I believe that was the current status of that information.
Yeah, Aaron had to move to another meeting. It's true. There is no final answer from the IRS as yet. They don't really seem inclined to provide one right now. So,
Yeah,
because other
that's been
states are
their,
asking as well.
that's been the IRS's status from what I remember, for years, unfortunately, with other states. So I don't know the impact to our customers receiving the insurance payment, whether, they're obviously going to have questions. So just trying to think of, get ahead of that. And if it is taxable income, we don't offer withholding. So, they're on the hook, the claimant is on the hook for, that added adjusted gross income and so forth. So we'll have to see. If you don't get an answer, I don't know what you're going to do other than you don't have an answer, right?
I'm sorry to interrupt. So I don't know if we're talking about the same thing, but the statute gives the
The
option to the
Yeah.
to the claimant as to whether or not we withhold state and federal taxes. Some people are asking that we do and some don't. So is that different than what you were just mentioning? Because for those
No,
that
it is very similar. So for the IRS, I guess it just boils down to whether or not the IRS is going to deem it taxable income, and they're not telling us. Therefore, it's going to be confusion on the claimant's part.
Right.
And then,
right,
for example, if we withheld IRS from the taxpayer, and it's deemed the IRS is, then they're due a refund. I mean, it's just a mess.
Correct.
Yes.
I know.
Okay.
Yeah.
So are we prepared to send out like a 1099-G in January on the insurance payment?
So Aflac does that for us, and
Right.
yes, they are prepared to do that.
Okay.
Yes.
Is it snail mail or is it electronic? Do you know?
Go ahead, Dave. You
Oh,
came off mute.
No, I was nodding at the previous statement. I
Oh,
don't, I'm
okay.
sorry.
I thought you-
I
They
I'm
are
not sure the
endeavoring-
answer to that question.
Okay,
Sorry.
that's all right. I do. They're endeavoring to send as many as possible electronically.
Okay.
All right. So and then if you really need it by snail mail, you can call the customer service line and get it. But we're really trying to deliver them electronically.
Sure. So I just offer an experience on this area because it can become challenging. Two things. One, if a person received benefits January, February, March, and it's not current in their mind, they may not know to go to their account to print out such tax document for their own filing or their tax preparer's filing. They just may not remember it, and then they have to come back and do corrections with the tax entities. So that's always a concern. That's why it's sometimes favorable to lean on just mailing them. Secondly, if you do mail, you're going to get returned mail. And one of the indicators of criminals is return mail, just letting you know that, and imposter claims and so forth. And I know we talked about that, but just bringing that to your attention for
Okay.
something that you may experience, January, February, March, and so on. Separately, great presentation as always. Is there any stats that are known on overpaid claims, the amount and the recovery of those overpayments.
I don't think we have
The
this.
finance team is getting a report on an ongoing basis of those, are they not, Dave?
Yes, we're actually working with AFLAC now to finalize that amount so we can record it appropriately on our books. There are overpayments that have been made, and actually I'm going to go to Amy's latest report, if you give me a second, and look up what the latest estimate of that number is. Bear with me 1 minute, please. The latest estimate for that amount is about $185,000 of overpayments that are out there that AFLAC is working to get back and retrieve on our behalf.
Thank you.
You're welcome.
Thank you.
Any additional questions for John or the team? Not seeing any. Thank you very much, John.
Thank you.
Is there any old business that anybody would like to discuss? Not seeing any. Is there any new business that anyone would like to discuss? Let's see any. All right, so may I have a motion to adjourn?
Motion to adjourn, Daryl?
Second, Mike.
Thank you. All in favor?
Aye.
Aye. Any opposed? Any abstentions? All right, the motion carries and the meeting is adjourned. It is now 10:07 a.m. Have a lovely weekend, everybody. Thank you for your time this morning.
Thank you.
Thank you.
Thank you.
Have a great
everyone.
weekend,
Have a
everyone.
great
Thank you
day.
so much.
Stay cool.
Bye.